aspects of the digital era, and we're starting off with a presentation by Lino Munaretto. And Lino studied law at the University of Göttingen and completed his legal clerkship at the Higher Regional Court of Frankfurt am Main, and currently serves as legal counsel in the Directorate General Legal Services of the Deutsche Bundesbank. So we're looking forward for your presentation.
Thank you very much for the introduction. Before I start, just let me clarify that despite of my professional affiliation with Deutsche Bundesbank, the views and opinions I will present are only my own and do not necessarily reflect those of Deutsche Bundesbank. That disclaimer is important because I'd like to talk to you about legal aspects of digital central bank currencies, CBDC, and monetary sovereignty today. As you might have heard, the European Central Bank is preparing to issue a digital euro. And some of you might ask, why are they doing this? Do we need this? You are not alone. The digital euro has often been described as a solution searching for a problem. So why should we be interested in this question as lawyers? Well, the success of the digital euro does not only depend on the willingness and readiness of citizens to use it. The EU legislator intends to impose several obligations on private actors, including banks, payment service providers, and merchants. The legislator is doing that to ensure that the digital euro will be available and accepted. The proposed digital euro regulation may affect the rights of private market actors, in particular, their freedom to conduct a business. Each state intervention interfering with fundamental rights requires justification. If the digital euro was a solution without a problem, interferences with fundamental rights could hardly be justified. One day, courts might have to decide on these matters, and for that reason, we should be ready to answer whether the digital euro and its design is justifiable under EU primary law. So, let us start by looking for the rationale for introducing the digital euro. All EU institutions present the digital euro primarily as contribution to the EU's strategic autonomy and its monetary sovereignty. The concept of strategic autonomy is part of the EU's reaction to geopolitical threats. It expresses the EU's ambition to remain open to international cooperation while being able to act autonomously where necessary. Monetary sovereignty is a manifestation of strategic autonomy in the field of money. In legal terms, monetary sovereignty can be understood as an entitlement and capacity of a state to regulate its own currency. It includes the power to issue the currency, to control its value, and to lay down rules governing its acceptance and use. In the euro area, monetary sovereignty has been transferred to the EU. But what exactly are the threats to monetary sovereignty that the digital euro should address? First, the digital euro is supposed to prevent a phenomenon called dollarization. This would occur if payments in the euro area were not settled in euro anymore, but in privately issued stablecoins denominated in foreign currencies, such as the US dollar. Second, the digital euro is meant to reduce dependence on foreign payment service providers like Visa, MasterCard, or PayPal. Recent events have demonstrated how easy we can be cut off from important infrastructures that we have relied on for quite a long time. ICC judges being subject to US sanctions were banned from using their US credit cards. And this month, the US administration banned foreigners from using AI tools provided by the US firm Anthropic. These cases reveal access to money can be weaponized by those who have the authority and power to control it. Against this backdrop, safeguarding monetary sovereignty against such threats seems to be a legitimate aim of EU action. However, strategic autonomy and monetary sovereignty cannot operate as blanket formulas that simply override economic freedoms. They must be assessed under the legal framework of the treaties, including the Charter of Fundamental Rights. This is why I'd like to take a closer look with you on the following aspects. Does the digital euro, backed by far-reaching obligations on banks and other private market actors, comply with EU primary law? Can strategic autonomy and monetary sovereignty justify interferences with individual economic rights? And if so, under what conditions? I will focus on a review of the right enshrined in Article 16 of the Charter of Fundamental Rights, the freedom to conduct a business. But before I come to this point, I'd like to say a few words about the general constitution of money in the EU. How does our monetary system work? What kind of monetary constitution is enshrined in the treaties? And how does it distribute monetary authority between the state and the market? The EU monetary system rests on a division of labor between state and market actors. Public money is issued by the Eurosystem central banks as cash and central bank deposits. Private money is created by commercial banks when they grant loans and thereby create deposits in customers' accounts. We can imagine this system as a pyramid, with public money at the top and private money at the bottom. This two-layer system works as long as public and private money remain fully fungible. Fungibility means that private money held in bank accounts can be converted into cash as public money at par. Due to fungibility, we don't recognize the difference between cash and electronic payments in our daily life. €1 is €1. This is a short story of the hybrid nature of our money. The hybrid architecture of the monetary system is backed by the monetary constitution enshrined in the EU treaties. The EU monetary constitution allocates monetary authority between state and market actors. We can thus call it a hybrid monetary constitution. On the public side, this constitution grants powers to the EU legislator and the ECB in Article 127 and the following articles of the TFEU. The legislator is authorized to regulate the use of the currency, for instance, its legal tender status, while the ECB is empowered to maintain price stability, issue cash, and safeguard the functioning of payment systems. On the private side, private banking activities are covered by the freedom to conduct a business, enshrined in Article 16 CFR, and the principle of an open market economy with free competition laid down in Article 119 and 127 TFEU implies that the allocation of financial resources shall be broadly left to the market. Now we can understand the highly political impact of the digital euro. A central bank digital currency has transformative potential. It could shift monetary authority from private banks to the central bank, from market to state. The ECB, however, insists that the digital euro is not meant to disrupt the hybrid monetary system, but to stabilize it. And the legislator has chosen a conservative design for the digital euro. This approach might not be merely politically chosen. Both the EU legislator and the ECB are bound by the hybrid monetary constitution. I will now focus on the question whether the digital euro complies with the freedom to conduct a business as one element of the hybrid monetary constitution. The freedom to conduct a business under Article 16 CFR protects economic initiative and the ability to participate in a market. It covers, in particular, the freedom of contract and free competition. Banking activities fall within the scope of this right. The digital euro regulation and its implementation may interfere with the freedom to conduct a business in three main ways. First, it may create displacement effects because under the proposed regulation, the digital euro would be a direct liability of the Eurosystem central banks. It would be recorded on the central bank balance sheets, not on the balance sheets of the credit institutions. Although digital euros may also be acquired in exchange for cash, funding will generally come from existing deposits at commercial banks. Private money recorded on commercial bank balance sheets would therefore be replaced by public money recorded on central bank balance sheets. Consequently, credit institutions will lose part of their deposit business. Second, the digital euro imposes financial burdens on financial market actors. Credit institutions must offer basic digital euro services upon request, and all payment service providers must provide basic digital euro services free of charge to end users. Their fees vis-à-vis merchants and other payment service providers are kept. These obligations and restrictions affect the freedom of contract. Providers are not fully free to decide which services to offer, whom to serve, or what price to charge. They may also have to bear implementation costs. Third, the digital euro may create competitive disadvantages. The legislator intends to confer legal tender status on the digital euro. Merchants would generally be obliged to accept it. Combined with free basic services, this gives the digital euro competitive advantages over private payment solutions, especially those that do not benefit from mandatory acceptance. Established providers may adapt, but innovative providers may face market entry barriers. Taken together, these effects amount to limitations of the freedom to conduct a business under Article 16. The final question is whether these limitations can be justified. Article 16 CFR is not absolute. The European Court of Justice repeatedly emphasizes that the freedom to conduct a business must be viewed in relation to its social function. Nevertheless, any limitation must satisfy Article 52 CFR. It must be provided for by law, pursue a legitimate aim, be suitable and necessary, and strike a fair balance between the general interest and the right affected. The provided for by law requirement is fulfilled, since the limitations will be laid down in the digital euro regulation. As to the legitimate aim, preserving monetary sovereignty qualifies as an objective of general interest. The European Court of Justice generally allows the legislator a broad margin in defining matters of general interest. In a recent decision of October last year, the President of the General Court has explicitly recognized that the digital euro project contributes to strengthening the strategic autonomy and monetary sovereignty of the euro area, thereby fulfilling an objective of public interest. The suitability test is also likely to be met. There is no precedent for a central bank digital currency of this kind, and it remains uncertain whether the digital euro will strengthen monetary sovereignty in practice. But under conditions of factual uncertainty, public authorities enjoy broad discretion. The argument that a publicly backed digital payment solution could make the EU more independent and resilient is at least plausible and not manifestly incorrect. What about the necessity of the limitations? The EU has already taken measures to address threats to monetary sovereignty. MiCA, the Markets in Crypto Assets Regulation, regulates stablecoins and imposes safeguards against crypto assets denominated in foreign currencies. Others suggest that a wholesale CBDC, meaning a central bank digital currency only for interbank payments, may be sufficient to preserve monetary sovereignty. However, these measures do not necessarily rule out the need for the retail digital euro that is supposed to be available to the broad public for everyday use. The retail digital euro responds to a different risk scenario, the possibility that the EU could be cut off from foreign payment systems. The example presented in my introduction show that state influence over private payment infrastructures can be weaponized geopolitically. As long as domestic operators have not established a pan-European payment system, there is a strong case for the ECB to ensure that an alternative infrastructure remains available for everyday payments. Given geopolitical uncertainty, the assessment that a digital euro is necessary cannot be regarded as manifestly unfounded. Finally, the measures must strike a fair balance. The more intense the restriction of economic freedom, the more important the interest in safeguarding monetary sovereignty must be. Several factors support proportionality. Most important, the regulation contains mitigating and compensatory mechanisms. Holding limits are intended to prevent large-scale transfers from commercial bank deposits into digital euro wallets. thereby protecting banks from displacement. And the compensation model allows payment service providers to charge merchant and other providers fees for their services. Finally, the essence of the right is respected in accordance with Article 52 CFR. A violation of the essence could arise if the digital euro prevented certain banking activities from being carried out as such. But because of holding limits and compensatory measures, credit institutions do not have to fear that their business models will be fully displaced by the digital euro. Nevertheless, the legislator and the ECB are required to review their measures to ensure their proportionality in the future. Article 41 of the Digital Euro Regulation expressly provides for such review. Measures initially necessary to introduce the digital euro may later need to be adjusted. Let me conclude. The digital euro is part of the Union's response to geopolitical tensions. It is designed to strengthen strategic autonomy by preserving monetary sovereignty. At the same time, the digital euro will burden private market actors. It may create displacement effects, impose financial costs, and affect competition. These burdens amount to limitations of the freedom to conduct a business. My central claim is that these limitations are, in principle, legally justifiable. Monetary sovereignty can constitute a legitimate aim of general interest. The threats to monetary sovereignty are the problem that the digital euro could solve. The digital euro is suitable and necessary to pursue that goal. The current regulatory design, especially holding limits, the compensation model, and the duty to review, also ensure that a fair balance is struck. However, monetary sovereignty cannot serve as a blanket formula for overriding economic freedoms. The EU legislator and the ECB must give reasons and review their assumptions. And they will have to adapt the regulation and its implementation if risks diminish or burdens become excessive. The legal design of the digital euro therefore complies with Article 16 CFR because it remains embedded in the boundaries of the EU's hybrid monetary constitution. A constitution that neither leaves money entirely to the market nor places it entirely under unrestricted public authority. Thank you very much.